right, so good afternoon, everybody. This is Phil Resch, and we are here accompanied today by none other than the great Jeff Tabor, coming to you live from Columbus. Not really in Columbus, he's in the Dallas-Fort Worth area, but for Columbus Life, we're here to talk about a couple great things. First and foremost, this is a two-part series. We're going to start dancing on the product side. So we want to know what products that Columbus has available, along with next week on the 21st, the day before I turn the old 42. We are going to have Columbus back to show how to run their illustrations, how to run the best way, and ultimately let's get the cases rolling. We're going to talk about a great contest that I have alluded to in my emails, my newsletters, and so we'll get rocking and rolling here. So I'll hand it over to you, Jeff. If anybody has any questions, feel free to put them into the Q&A section, and we can answer them throughout the presentation. And yeah, so Jeff, over to you.
Terrific. Thanks, Phil. Got to spend some time with Phil this week, which you all know is a pleasure. Always good to be with him and some of his folks. Looking forward to this relationship growing, looking forward to hosting you all in Cincinnati next June. We'll hit on this as we wrap the meeting, but it's an exciting thing. It's a great trip. I've had other producers up there. Phil has been up there and gotten to experience that. Our people do a good job. The baseball stadium is in walking distance from our hotel. It's just a great evening and a great time. Plus, we'll get some time in the home office, meet some of the players, underwriters, advanced sales folks, and all that. So really, really a good thing. But to make that happen, we all obviously need to sell some life insurance, and that's what this is all about, showing you some of the whys and wherefores for Columbus. And I'm going to go fast because I don't want to get you bogged down. I want you to just make notes. If you've got a question, by all means, post it and we'll try to get to it. But make a note, shoot me an email, give me a phone call, reach out to Jennifer or Phil, and let us make sure we're getting you what you need and answering your questions. So I'm just going to start at the very tip top, and that is with ratings and who we are. I often say we're a 96 Comdex mutual company with top tier IUL and terrific compensation. That's sort of in the nutshell who we are. Part of the reason we spend a lot of time in that spot is because after 135 years, you've seen a lot of things come and go in the economy, but also you've seen a lot of companies come and go. And those of you that have been doing it for a while might recognize some of these names. In the 80s, there were 2,800 insurance companies. Now there's less than 800 or around 800. So there's been a gigantic consolidation in the industry. What you don't want to be is you don't want to be an owner of a policy inside a closed block. And by that, I mean, it was a company that existed. Let's say you had a Hartford policy or a Met policy or an ING policy. Well, now that's managed by a company that is not selling ING or Met or Hartford. And their view of that is an asset that's supposed to have a certain return. And because it has a certain return and we're not marketing under that anymore, there's a tendency to get in there and tweak the numbers and make changes, which are allowable, but some companies think a little harder about that if they're selling it under the same name. Some don't, and we're going to talk about that as well. So being around for a long period of time and seeing some of the changes as a mutual company, our life's pretty clean. We don't have shareholders and stockholders. So we're not going to have the sneaking surprise that Hartford and Principal and some of the others have had, where the shareholders get all disgruntled and want a bigger piece of the pie. So part of what we're going to touch on today is we've got three terrific IULs. We've got some underwriting to talk about, top tier compensation, which we'll definitely spend a minute on, a mobile app, which we may or may not touch on, but if you've got a phone, you've got access to the home office, your pending business, and the ability to communicate, which is great because you're always in contact. Two great conferences. So in addition to the contest that we have that Phil mentioned, we also have two other conferences we do every year to great places like Maui, Grand Caymans, Mediterranean cruises, all sorts of things. Sales support is hugely important in this business because, you know, it's hard to know everything, and it's good to have help where you can get it. We've got 3 sales attorneys. We're fixing to add a 4th one. And more about that side of the business is going to come out. So if you are in that space, estate planning, business planning, we're going to have some great assets coming in that. And then, of course, the award-winning sales desk that we have that helps us push through and get things done. So let's jump to product. The philosophy that Columbus follows is sort of twofold. One, keep it simple. What we figure is easy to understand is easy to sell, and these products are complicated enough with all the moving parts without overcomplicating it, putting things in that add confusion and complexity, and sometimes freezes up a sale because the client feels overwhelmed. So ours is pretty straightforward. We try to minimize the moving parts and pieces. In cases where we're doing bonuses, we guarantee it. It's not a trust me kind of a thing. As you know, there's been quite a bit of movement in the IUL space over the last 5 years. We've had 2 or 3 bites of the apple from the NAIC, changing the way we do illustrations so that we don't overstate or overrepresent what can happen. The challenge is it's a never-ending battle. It's a little whack-a-mole. Here's the latest iteration of what's going on in the marketplace right now. Everybody's claiming these high cap rates, and they illustrate it up here in the orange, like, you know, isn't this great? You know, provides great returns. We're down here in the green, and if I was a client and didn't know anything, I would pick orange over green as well. The problem is most all of these companies are reducing those rates in renewal years. They're doing it up here for the illustration. They're doing it down here for the policy. And as you know, the policy is what governs the contract and what governs the returns those clients get on that contract, not the illustration. That was out of date the moment it was printed, right? So carrying it further, here's income out of that same. This is a company we would all recognize, ran their stuff, verified their renewal rates, and this is how this thing rolls. So you've got $44, almost $45,000 versus our 34. I get it. Orange is better than green in this case. The problem is, in reality, it's red. I can't stress to you enough how critical it is that you embrace this, because there was a study done by a very large insurance organization just recently. Phil knows who they are. They went out, they contacted every insurance company and determined what their renewal structure looked like. What they determined is there was only 2 companies that give you the same cap rate at issue as you do at renewal. And that's us and Mutual of Omaha. Everybody else follows this sort of pattern, which to me is all, I mean, I have to say it's almost criminal in the sense that you knowingly are illustrating something that you're not going to support. And part of the reason I stress this so much is we have a good product and we're going to review it, and it's competitive and it does a good job. And I get why companies do this, because whichever company this is, there's 5 others doing the same thing. So everybody's trying to compete at this level, when in reality, we're all dealing in this world. And so, you know, that's where it is. So difference here is cap rate and in-force rates the same. We currently have a cap rate of 10. Our in-force rate policies we've had for 15 years are also getting 10. So that's the difference, and that's enough of my soapbox. I'm stepping down now, and we'll get on to
real quick.
Yeah.
Um, so I don't think I think you should stand on that soapbox a lot more, because a lot of times what people don't realize is, and that's one of the differences that really I want to put with people is it's so easy to run an illustration that looks pretty because you're trying to sell it, you're trying to make some money. But at the end of the day, that's the start of the commitment that you have with your consumer. And so if you're going off of smoke and mirrors, you know that you're going off smoke and mirrors where illustrations will change. That's why the realistic expectations of what you have, you can go to your client year after year after year to show them the actual returns match what they were looking for, versus some other companies that have used multipliers in the past have caused them to get lawsuits and angry customers who put a mar on our industry. We're here to make a difference, make a buck or two as well. But really, this is the best opportunity to show value to our clients. And so I think, as you say this, as it's linked there, and as you'll talk about, yeah, 44,000 is better than 34,000, but 100% of zero is still zero. If I have a higher probability to hit 34,000 with a realistic expectation, and who knows, maybe I'll get 38,000, but the 44,000 could be 30,000 due to multipliers, bonuses. So having a very clean and easy design on the front end will help you on the back end for your customers as well. So, just want to overemphasize that in your simplicity of your product. Yes, it won't illustrate as sexy or as pretty as some other ones that we might be used to, but it doesn't mean it's a bad product. It just means it's different. And I think that's something that we have to understand is explain that story more about consumers as we're educating them, to our clients too. So just want to overemphasize that point of interest for those listening. Really take note of that, because the start of your commitment to your client is the signature of the policy. You're getting fronted money to watch that policy for the next 20, 30, 40 years. So this is very important. And then I'll step off my soapbox.
No, Phil, I appreciate it. I do. I could go on for a while. For those of you that are intrigued by this and want to know more, there are articles I can send you, some different marketing pieces that highlight this feature and some other features that Phil references, bonus and multipliers and all that. It really teases out the what's going on behind the scenes, and often what makes these things difficult in your shoes, because you're going in the door with company X and you're concerned somebody else might come in the door with company Y. So I'm pressing my home office to help us, me, educate the client to this stuff. I mean, otherwise they're going to the internet and God knows what they're going to find. So I'm trying, and I think we're making some headway, and I'm hoping in the first quarter of next year, we're going to have some things that talk about this from a client level so that you can educate and, sort of wall off the person coming in behind you and maintain the sale to the client and the initiative in pursuing the insurance with a client. So the Index Explorer Plus is sort of our flagship product. It is, and Phil described it accurately yesterday, it is sort of a do-it-all type product. It's not chasing the guaranteed side of the business. It does a good job of accumulation, but it's not only accumulation. I sell quite a bit of it in the estate planning market. People saying, I need $10 million of coverage. How much money do I need to pay to age 100? And it does a very, very good job of that, competitive, particularly when you throw in the stability of the product and the company, because an estate planning case is typically a very long sale. So from that perspective, it's got a lot of products and features to it. Apologize, boss was calling. But I'm going to hit on these three things right here because these actually it's not just insurance, it's different ways to look at the insurance, different ways to design the sale, which might enable you to capture a particular client's interest or fit a particular circumstance the client may have. PDA is premium deposit account, DCA is dollar cost average, and ECV is early cash value rider. And we're going to touch on those right now. So DCA and premium deposit account, we're going to touch on first. The DCA account, that's an investment term you may be familiar with, which says you're better off funding, if you're buying mutual funds, you're better off funding them monthly or periodically than you are buying lump sums, once a year. What the DCA account does is take your client's annual premium. Client still pays an annual premium, so you get paid, but then we put the money in monthly. It earns interest while it's sitting there, so it's not just idle money. It's actually earning interest on top of what it's going into. So at the end of this first year, you'll have 12 buckets instead of one. The reason that is important is because there is such thing of sequence of returns. We've heard about that. Here's an example, and I've got a live case of this very same thing that happened. Here's a client who dumps all his money in January, and then in next year looks at his deal and he didn't earn anything. Well, if he'd have waited or had done dollar cost average, he would have gotten a piece of every bit of this, plus earned the interest on top of it. I had a big premium finance case, 2 doctors, partners, and it was a paperwork chase at the very end. One got theirs in about a week or two earlier than the other, and it landed in the January bucket. The other one did an annual premium as well in the February bucket. The next year, he got 12 and change as his return, and his partner got 7. And imagine the explanation that had to go on beyond that. So dollar cost average is your friend. It's a way to spread out those returns and guarantee that you're going to get a better average than you are if you just spin the lottery or spin the wheel and hope that you get something different. So it mitigates risk returns. It's an automatic plan. It pays interest along the way. So it is a real benefit. Now, the premium deposit account is a separate account. It helps us avoid the MEX status, and it streams the money in 4 to 10 years. So just like the DCA holds the money, the premium deposit account holds the money, pays interest on it. And the interest, by the way, is 4%. So not a small number, not some nominal number, but it's 4%. So it holds the money, pays 4% of the money, and then streams it in 4 to 10 years. And I'll show you an example of what this does. The benefit is it captures all the client's money. So if a client sold a piece of property, inherited money, rolled out of some other investment, you can capture all that money at once before they go buy another piece of property or a boat or something of that nature. It avoids the MEX status, which, if you go in and drop a bunch of money in an IUL, it's going to push the face amount up and look for future premiums. This avoids all that. So here's a client situation, just to give you a quick example here. He had $250,000. Instead of dropping it in at one time, we did it $50,000 at a pop, kept our face amount low, and he got an extra 10 grand in interest. This interest rate back then was 2%. So I just did one the other day. Guy put in $500,000 and he had $96,000 of cash additional added premium. So it does make a difference. He was streaming his in over a longer period of time, and there was some compounding going on there. But this is a terrific tool. Just as an example, imagine you've got an annuity and the client says, I'm just going to give this to the kids or grandkids. We know transferring money through an annuity over generations is not the best. It's better off in life insurance if the person's healthy. You can sometimes double or more the money. Well, this is a great place to put it. They've got $100,000, $200,000, $300,000, $400,000 sitting in an annuity or a bank account. Where am I going to put it? You drop it in the premium deposit account. you can go one of two ways. You can minimize the death benefit to maximize cash. That's one alternative. Or you flip it and you go, I want the max death benefit for my cash if I'm doing legacy planning. So premium deposit account is your friend. Now here's the money shot on this. When you put your money in the premium deposit account, if you check the box on the app that says dollar cost average, you'll get interest while it sits in the multi-year bucket premium deposit account, and you'll get money on the dollar cost average as it streams it in and makes 12 buckets out of each of those payments. So it's a way to really juice the client's return and do it all automatically. All you're doing is a little paperwork at the beginning and some design on the illustration. The next one is the early cash value rider. The early cash value rider comes about in the situations where, you know, there is currently a 10-year surrender charge on the policy. And some people just do not like seeing those zeros in the early years. And in some cases can't take zeros in the early years, like in a business sale or something like that. Or let's go back to the idea that I just mentioned a minute ago, where I've got a little old lady who's sitting there with $250,000 of an annuity, and she wants to roll it in, and you show the life insurance policy and she sees all the zeros and she's like, where'd all my money go? You roll on the early cash value rider, and all of a sudden it looks better than an annuity in terms of surrender charges. It's got 96 or better in the first year. So now all of a sudden I've got juice. Now I know what you're thinking. If you've heard of this feature before, you're going, okay, Tabor, I dig it, but I'm giving up compensation. With Columbus, you don't give up compensation. You extend the chargeback period from 1 year to 5 years. But if the client's rolling the money and everything's going, it's not going anywhere anyway. So it's a way to give the client what they need, which is get rid of the zeros and show them a decent return, and provide a terrific sale in terms of an alternative for where that money goes. I got a call yesterday, and Phil and I were running home from our meeting, and a guy says, I just struck a deal with a property and casualty firm, one of the biggest in that particular state. And he said they have a ton of bond clients that have to have bonds to do business, construction companies and the like, that say, I'm sitting on all this bonds, but the bonds are backed up by cash, and the cash is sitting in the bank and it's not earning me anything. Or it's, didn't used to, now it's earning them a little something, but it just sits there. It's a corporate asset. It has to be on the balance sheet to back the bonds. Well, guess what? Life insurance cash value looks just like a CD from a lender or a bond issuer's perspective. So he's going to transfer money from client left pocket, put it in the client's right pocket, do what I just showed you, dump the money in, use the PDA, use the early cash value rider, and now all of a sudden the owner's sitting there going, okay, no longer do I have idle cash sitting in my organization, not doing anything to benefit me or my key employees. So that's another great strategy where the early cash value rider can really benefit for you. So switching up, we took our existing Explorer Plus product, cloned it, made it a survivorship product. It's different than some survivorship products in that it builds cash versus focus on guarantees. Gives you a little bit more flexibility. I get it. Some people need or want those guarantees in a survivorship situation, but those that are market oriented, or I'm going to show you an example, or are interested in accumulating cash, this is a really good alternative, because what does survivorship do is it blends the mortality between the two insureds. Typically, husband and wife have different mortality. Typically, she's younger. Typically, she's healthy as he is. And you get this disparity in mortality. So instead of just insuring him, you're insuring both. It provides some leverage, some additional leverage for your cash that's going in to increase the death benefit or increase the cash value. Also, for planning purposes, we can take one person as an uninsurable. So one healthy, one not healthy. But here's an example, and this example probably needs to be rerun because it's a little dated. I noticed this as I threw it in there. I didn't have time to run the numbers because it's showing a difference, but I've seen bigger differences when our cap rates were higher, and we've raised the cap rates 4 times since this was run, as a matter of fact. And I will tell you, we raised the cap rate 4 times on our illustration, and we raised our cap rate 4 times on the enforced policy block too. So here's what happened. So typically you're looking at a 50-year-old trying to save money. That's when it starts to get squishy in terms of return. Okay, if they've got a longevity issue and they're worried about running out of cash, it can make sense pulling money at 70 or 75 out. I get that. But look what the leverage gets you if you do husband and wife versus doing husband or wife. This is about a 10% gain over the wife. I've seen it as high as 25. When the cap rates were a little better, I have a feeling we're somewhere in between there now. So think about survivorship the next time you're looking at LIRP. The commission's the same on both products, so you shouldn't be giving up anything. And I think a really good alternative to the typical LIRP sale. All right, last product to run through is our rapid issue product. We had an accelerated underwriting process. It wasn't getting enough cases through it to make it really helpful. So they redesigned it. They took the existing Explorer product, they blended preferred and standard rates, came up with 4 underwriting classes, and said up to $1 million, up to age 50. We'll do it with no fluid or no exams. It's a real clean process. There's some 3-mark producers that are selling the snot out of this. They love it. They say, they told us, don't change anything. It's working. Fill out the part 1 electronically. The client fills out the part 2 electronically via an email. I've had agents who fill out the app with the client on the phone, send it in, wait for the client to get the email, and then sit with the client and fill out the part 2 as well. Just keeps you in control and manages the sale. So a great way to go with that. But this is a really good way to move through cases quickly if you're dealing with situations where you know the client's not going to hold still, not going to wait around, and they're healthy enough that you're not going to get tripped up in underwriting, because you do need a healthy person here. You can't have anything, rated situations or whatnot. We'll take some, and you can pick up the phone and call an underwriter or call one of us, and we'll run it by them and see what fits and what doesn't. But the nice thing is it gives you another underwriting option. And in essence, you've got 2 doors in which you go through with each client. Depending on face amount, you could use the rapid issue process, avoid the exam and blood, and move through the case rather quickly. If you've got somebody that thinks they're super preferred, wants a larger face amount, or has health problems, then you're better off over here, because there's a feature I'm going to talk about in detail in a minute that's going to help you mitigate some of the niggling little table 2, table 3 ratings that pop up, particularly for overweight and diabetes and those sort of things. So you've got a choice. You can go now, as someone said, do now or do later. This is traditional underwriting. Exam, blood, the whole bit runs through, no big deal. Stuff you've done all the time. And this is the rapid process. So again, a couple of ways to go, no exam, no phone interview, 4 underwriting classes, and it says 3 to 5 days. We're actually getting them out the door in 2 and 3 days. So it's moving really, really fast. Ran on the back turn here. I'm going to just touch on living benefits. As you get familiar with Columbus, spend some time with Jennifer, myself, Phil, on the company's website. There should be some training stuff out there on our living benefits. They're different than what you normally see in living benefits, and I think they benefit the client in the way that we've designed them. Yes, it's terminal illness, chronic illness, specified medical condition, same thing that you've seen from many others, same sort of triggers. in all of these. Ours are pretty clean. Doctor's note usually gets it done. Don't need much more than that. 2 of the 6 ADLs, cognitive, all those kind of things. But the deal is our calculation is pretty simple. We give you a percentage of the death benefit and we give you 100% of the cash. So you're selling LIRP cases with tons of cash. You've minimized the face amount and potentially have even, some people argue our percentages are low. I argue we're giving you all the cash, and we've got an alternative calculation. Most people forget that we'll take it up to $1 million just on death benefit. So there's room there. The other piece of it is there's no additional underwriting. A lot of these other groups that are doing it, it's part of the way their features are designed and built. When you go through the claim process, it is extensive. Some people call it underwriting. I would just say it's an inordinate amount of questions that are asked because they've got to go through a calculation because the fee that they get paid is different than ours. Our fee is treated like a loan on a policy. It's an interest rate. Their fee is a lump sum payment, and they're trying to figure out how big that lump sum is. And so they ask all these questions that you're not going to know until claim time, which means it's difficult to predict how much money your client's going to need because you don't know what the claim circumstances and when it's going to happen. So again, ours is simple, pretty clean, no additional stuff. Send the doctor's note. We're filing, getting claims out the door in a couple of weeks. You can, on our illustration, year by year, you can see what the benefit amount is. And ours has a built-in residual death benefit. Some of these companies give you the big check on living benefits and take back the policy. So the policy disappears. So clients having to make a choice. Well, do I take the money now or do I wait and support my beneficiaries down the road? And it's kind of that Sophie's choice deal. Here, you don't have to make that decision. There's going to be a death benefit there. So the underwriting program I mentioned a minute ago was the table shave program, which essentially says 20 to 70, 25 to $1 million on all our permanent products will go standard instead of table 2 or table 3. You don't have to ask for it. It doesn't cost extra. The underwriting comes down, sounds something like this: due to height and weight, build, history, this client's probably table 3, but fits our table shave program. We're going to issue standard. Shall we issue? That's it. It's no more complicated than that. And you say, stab it and steer, issue that policy, I'll take it. So a great tool to have in your back pocket. Again, back to the point where you're picking between products, that's where the table shave comes in. So you bounce back and forth depending on where your client is in terms of speed and health, and you're in the driver's seat. I mentioned the app on the phone. We're probably on our 6th plus generation of this thing. It's pretty robust. You can run quotes on the thing. It's a really great feature. All right, we do all this for a reason. We want to take care of our clients, and we expect a little bit of a reward. And a reward is kind of where Columbus cuts their teeth. I think has one of the better comp packages available. Target's competitive. They roll forever. The payout is often bigger than, there's bigger targets out there, no doubt. There's bigger payouts out there, likely. But we stand sort of at the top of that tier, as I said, top tier. We pay excess commissions above target. We pay renewals out 12 years, not 8 years or 10 years. We have a deferred comp program so that if you're making so much money and you want to defer some, we can make that happen. We have trail comp, which I'll touch on in a minute, which is essentially, I was coming up with this the other day. Phil, tell me what you think of this. Essentially, what I say is, because of trails, we pay compensation twice. We pay you first on all the upfront stuff, and then we pay you from year 2 through the life of the policy on trails. And trails are paid on the account value. And what are we doing on a lot of these policies? We're growing account value. You're getting a tiny, tiny piece on that thing forever. So that's a pretty cool thing. 2 conference trips, like I mentioned this year, it's the Bahamas. Qualify for the regular trip. You get there, you spend 3 or 4 days with us. You qualify for the big trip. It's a whole week spent in the Bahamas. So a terrific place. Like I said, we've been to some really good places over the years. They typically stay in Four Seasons and Ritz-Carlton, so high level of service. We're staying at Baymar or Bahama Mar. If you're familiar with the Bahamas, that's really, really good. But in addition to that, because of Phil's efforts and having spent some time with us at the home office and in multiple conversations, we're going to make it better. And better is the contest he's been teasing about. 2024, all expense paid to Cincinnati in June, a good time of the year to be there. We stay right downtown. All it's going to take is 15,000 of annual production between now and the end of April. We'll cover your hotel, we'll cover your airfare, plus we'll go to a Reds game that evening on the 25th. We'll get this thing sorted out as we get closer and give you some more details. But a great evening at the ballpark, a great day in the home office, meeting key people in the home office, senior management, underwriting, sales support, and you come away from that feeling the Columbus connection and what it's all about. So this is a great trip. Like I said, Phil's been there. These guys do a good job up there. They know how to make it done, and they know how to pivot, don't they, Phil?
Absolutely.
Yeah, I don't want to commit that we'll be in the suite, but that's the goal, is that we'll have the suite that night, but it's going to depend on the body count and all of that. So anyway, we've got a number of seats, regular seats. We've got a suite. So we can make this work. So I encourage you to take advantage of it. We kept the production amount relatively low because I didn't want to make this a premium chase. What I wanted to make this, as much as anything, is I want to pay you for the effort of learning Columbus. I want to pay you for the effort of taking time to learn the app, learn the underwriting, learn our process. I get it. It's just like it's not quite like changing broker dealers, but it's similar in that it's change and it's difficult, a different pattern than you're probably used to. So I want to pay you for that effort, which is I'm going to reward you with a nice trip and a baseball game. And so you'll be seeing more and more on this in the coming weeks and months. We really hope everybody gets behind it. And Jennifer and I are poised to help you out. So strong points on Columbus: 3 top-tier IULs, top-tier compensation, award-winning sales desk, the service and support between myself, Jennifer, Jennifer's 2 bosses who've both been my internals before, Mike and Eric. Super people. You'll get to meet them if you get to Cincinnati. You've got a plus the 4 advanced salespeople that we're going to have. Some really, really good folks up there. This is Jennifer. You can reach her at this number. That's her team, so it's not just her. She's backed up by 4 or 5 other people. And you need something, you know where to call. Well, that's it, Phil. I kind of came to
say you dress to impress. You dress to impress, Jeff. There's a couple questions in the chat or the Q&A, which we'll definitely get to. But I would like to just address a few points, and because I set the meeting up, I'm going to ask a couple questions myself.
Yeah.
But first and foremost, thank you so much, Jeff. As a lot of you know, I was a wholesaler before this, represented another company that had similar living benefits, but different. I really like the value proposition that you see with Columbus. But really it boils down to the partnership. And over this last year and a half of transitioning into this agency type role, you look for those who are going to be in the trenches with you, who really care about your business, and the partnership is there with Columbus. They are very much like my alma mater, if you will, where it's more of that career mentality, but yet we still have that benefit of the brokerage side if we need to. But they'll bend over backwards. Jeff is a fantastic person. We've met on various different places. I think where Texas, Atlanta, Florida, you name it. We've seen each other, and just an overall great guy, great person to work with. So, what I will say is that this contest just $15,000 in 4 months. So some of you that's a case, some of you that's 5 cases. Really, from the standpoint of what we can do to help benefit our partners to diversify the portfolio. Columbus was also a great asset for a case where a guy had a high A1C. We're talking like 8, and that table shape program got him to standard. And so when you think about it, some of my agents have clientele who have a touch of the sugar. So this is a very important, piece of information to remember when you're talking to your clients. It's not what looks the prettiest. It's what's going to get them across the finish line. And we could show them pretty illustrations from very cheap looking carriers from a pricing or product standpoint. But anytime you go and deliver a conversation to a client, you always have to think of 2 things. It's pricing of the product and underwriting. So if you have a client who, is set differently than, someone who's a little skinnier, then they might not fit with the pricing for the company that you're pivoting to them. So once again, it's us from an education standpoint to explain to our consumer that there's a reason why I'm picking this company. And there's a reason why this makes the most sense to me. Hopefully you can feel the same way. But it also goes back to show them 2 illustrations, A, B, and why A, why B, because if you show them A or nothing, then they're going to pick one or the other, and you might walk away with nothing. But if you have A or B and explain the differences in a highly educated manner, not A, B, C, D, E, F, because then they'll say too many. I'm going to have to think about it, but A and B, now you have a story, and it helps you close more sales. But in this case, some of the things that I really, really, really love, PDA, huge opportunities. So those of us who deal with realtors, real estate people looking to put money into an alternative asset that they don't want to manage. Jeff, my question, my long-winded answer to get to the question is, on the PDA, you have what, 90%, 80%-ish cash value when you stuff that money in. Now, in that standpoint, can someone borrow that, what is available for cash surrender value, to put into an investment, then once again, pull it back out, put the returns back into the product, and have it continue to do its thing? So that's my first question.
Yeah, we can't illustrate it currently, but client does have access to the cash in the first year. And if you're using the early cash value rider and it's chunked up all the money that's been put in there, it's all of, forget the percentage that's available, but a big chunk of it's available for loan. I've got some guys that have used that, and yep.
For those who have maybe kids going off to college in the next 4 years or so, and they want to kind of mitigate that rule for FAFSA on what cash you have available, here's another alternative with the PDA to put assets away and maybe borrow against it, like we talked about 529 alternatives. So just think of some ideas from that standpoint on the PDA. My other question would be, can you use the PDA and the early cash value rider together?
Yes.
Okay. Can you use the PDA, early cash value rider, and the DCA together?
Yes.
Good God. So you have monthly diversification, you have the ability to put the money away all at one time, and you have 80 to 90% of your cash value available in year one. That's like a trifecta right there of opportunity. So that warms my heart. This is my excited voice. And really, I want everybody to get on this trip. I want everyone to have the opportunity to come. 15,000 is not a lot. And those of you who are agency managers, if you have agents in your organization, those trails that they get on their sales, you will also get a trail on their trail. So if you build an organization, you like the story, and you have agents who also sell it, then you get a fraction of that trail. So a lot of times when you think about assets under management, financial advisors, that's a huge thing for financial advisors. You are being rewarded. You get that big paycheck up front, but you're going to be rewarded over time with that cash value growth that's producing inside of a very clean vanilla policy. So that's a huge asset on the back end to help you grow your practice, continue to get residual income as well, and support your client with a very simple and easy product. Not sure I'm going to answer your question. We didn't talk about the term because Jeff and I already know there's a fundamental agreement that the term is okay, but it's not really what Columbus is looking for. So they place the target premiums really low on term. I have sold it because it was what was best for the client, but you know, we can always talk about that for other options. If they're planning on converting later, for sure. But that's why we didn't really talk too much about the term today. Jeff, if you want to answer in a more
No,
political
you
aspect,
nailed it. No,
feel
you
free
nailed
to.
it. I appreciate that. Yeah, it's just, it doesn't fit the brokerage market right now. It's a good product. It would be one you would want to buy on yourself, fully convertible, has living benefits, but is a product you're going to make money on. There's other places to go. If you're going to convert it and make money on the conversion, then as Phil said, that can make sense. I know guys that have done that. Anyway, but you're spot on.
Yep. Now, real quick, could you touch on immigration status, visas? What do you take? What do you not take? Some of the people, you know, in this organization are of Eastern Asian descent, Southeastern Asian descent. So that's always a question that comes up. Coming in on H-1B visas, what do you guys take? What are some of the parameters? If you know that off the top of your head. If not, we can pivot and we can do that next week. So
Yeah,
I just don't know if you know.
and at some point too, we can grab an underwriter and get them on the phone too. But I can answer it sort of in a broad stroke. I don't have the ability. I'm going to go to the what I can't do and then back up to what I can do. In my mind, there's a couple of things that have moved in the foreign national space over the last 10 years. The first thing that took place was all I needed was somebody with some nexus, some financial nexus to the US. A bank, a piece of property, something like that. In a business, that's not us. We're not there yet. I'm pushing, but we're not there yet. The other more recent last 3 to 5 years has been no legal status, but they have an ITIN number, and a lot of companies, more companies are now doing that than used to. There's 2 or 3 now. There's 3 or 4. I don't have that yet available, and trust me, I've been pushing on that hard for 3 years. Not there yet. So what can I do and address some of the client? As long as there's a legal status, a visa, H-1B, those type of things, they live here now, been here 9 months, I can do those all day long. That's not a problem. So if you've got those type of clients, we can roll, and they're pretty good. I mean, I had one the other day that said, he's overstayed their visa, but they've applied. Our folks said, fine, send us the paperwork where they show that they've applied, and we kept going. So they were pretty good with that. So that's the broad strokes. Happy to take questions in an email or a phone call if you've got some specifics. We'll run it up the flagpole to underwriting and get them to weigh in.
I think that's a good answer because, and to kind of piggyback, I saw we have a client who right now is looking to put a lump sum into life insurance. So like the PDA, but they have an EAD. And we talked about that when I was in Cincy. You have H-1B, your worker visa. EAD is the next step right before we get to a green card. So it would fall in line in the lineage, they're actually closer to a green card than they are getting kicked out. So, if you could just get that answer, I
Yep,
forget where we lied with that, but,
I agreed. I'll find out.
okay. So, and then, I'll get back to you on that one, Agent Anonymous. Another question, good question came up. So PDA, you got early cash value. Is this a good product for premium finance?
I just did one. Nice big case. I've done a bunch of them. It's those of you that are in that market know it's a little tough right now. Cap rates historically are down a smidge, and interest rates are up, so it makes it a tough market. But for the right client, the right circumstance, yes, and we do use this product, and it does work well. And particularly, I've got 2 or 3 of them working. I'm getting one in January. It's a $3 million drop into the PDA. And it's a finance, it was pretty case. But yes, we can do that. We've got to vet the producer. We've got to vet the lender. We've got an approved list of lenders that we use. We don't do a crap ton of this stuff, if you'll pardon my expression, but we know our way around it. And we know what we like and don't like. And I would say nothing that's going to surprise you. It's pretty straight down the middle premium finance stuff. So if you're used to the net worth over 5 million type thing, and probably tends to be a smidge on the conservative side, but these days I think that's everybody. But a good product.
And to be,
your question, yes.
yeah, I was just saying, to be fair, agent who asked that, we can partner up on that because my alma mater was very scrutinizing for premium finance when we talked about this in the past, Jeff. I think I understand some of the parameters you're looking for. I have like 3 or 4 banks that I've worked with on cases in the past that are pretty in it from that standpoint. So if agent, you want to reach out to me, we can always talk about the opportunity there. Definitely still a hot topic, still a good story, but I think with
Yes.
this product too, clean, easy, no multipliers, it's probably a better one to go for with the client anyway. So
Well, and
great question.
I will tell you also right now, pardon me for interrupting, on the
Yeah.
cases we've done over time, the folks that have sold it with us are more happy than they are with our competitors, because the renewal cap rates have been going down and they're getting collateral calls and all sorts of things. So it's driving them nuts. So that's part of the reason why having a stable product and presentation bodes well for your client, because it's something you could. In fact, I had one this morning, and they called and they said the client's concerned because the cap rate was here and we were illustrating and we went and looked at the original illustration, and we looked at the guy's cash value. It was remarkably similar 5-6 years into the thing. So
That's what you're looking for.
yep.
That's
I mean,
that's 100% what you're looking for.
Up and down sort of returns, but they ended up where they should be.
All right, so last question, because I know we're butting up on time. Guys, great questions. This is probably the most questions I've had in a long time, which shows interest, which I love. Don't forget, next week, same bat time, same bat channel. We're going to be having illustration design, so you can show how to illustrate this bad boy, and implementation, of course. Last question is it possible to see the index account historical performance since inception?
Yes.
What I will do, okay, good. I'm going to take that a step further. Pars and cap rates, are those
Yes.
visible somewhere too?
Yes. In fact, if you want, Phil, it's on the website. So once you guys get contracted, you'll be able to go in there and see it at any time. I'm pretty sure I can download it as a PDF and email it to you, and that way you can get it out to your troops.
Great. Yeah, I think that's extremely important. Great question, and the fact that you answered that so quickly. Because if someone said that when I was with my other guys, I'd be like, because they would be like, oh, it's on the website, or it's on their marketing site. So the fact that you answered that so quickly, awesome. Thank you, guys. Thank you, Jeff. Truly, it's been a pleasure. And, for those, once again, who are here next week, illustrations. And I think we can owe it to our partners at Columbus. Like I said, 15,000 in 4 months. That's all it takes. 4 months, but start to finish, let's get them in now so they're ready to go January 1. Any last words from you, Mr. Tabor?
No, just appreciate your time and support. Looking forward to hosting a big crew from your group in June. Be a great evening.
Thank you so much. Thank you, everyone who joined. You have a wonderful rest of your night, and we'll talk soon.
Thanks, Phil. Take care of yourself.